Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
All right, folks, you're on the Property Couch. Each week, Ben and I bring you the insider's guide to property finance and money management. Hello, mate.
Hello, mate. How are you?
Good. And do we need to introduce? I haven't seen you for days, mate. Have you?
I've been busy. Been trains, planes, and automobiles.
Mate, it's nice to hang out. And the obvious upside of not seeing you for a little while is that you don't get to heckle me about our
JTL game.
Yeah, JLT even.
JLT. Yep.
So
Pies v.
You've got 10 seconds. Go.
10 seconds. Oh, mate, the pre-season means nothing.
All right. That's it?
That's it.
Okay, good. So today...
27 points.
So today we're going to do a speed... I say speed date. I can't think of any other better. But we put the shout out through
speed
socials
Q&A.
and through email.
Yep.
We're going to try and get through as many questions as we can today, because there's quite a few.
Yep.
Because we said to the folks, if we read it out on the podcast, Ben, we're going to send them a book of their choice.
Yep.
Whichever one they want. So the mission for you and me
is to
give away as many books as we possibly can today.
Love it.
But before we get there, Ben, a couple of things. For the people who listen on Thursday, Ben.
Thursday.
If they wouldn't mind tuning into ABC tonight, 8 o'clock.
Oh, yes.
My episode's on.
Great.
Escape from the City.
Number 2.
Yep.
Number 2 of, how many you got? 9.
9, yes.
Great.
So,
throughout the year, I'm looking forward to them.
So, will you be watching?
I'll be on a plane.
You'll be busy.
I'm on a plane.
Couple of things, Ben. We're nominated for a Logie.
Oh, congratulations.
Thanks, mate.
That's really good.
Might make it to the...
Is it a viewer choice one?
Yeah, well, we've got to vote, right? So,
okay.
So
well.
people have got to get the...
So we'll have to send the link.
I've sent the link to Iris, so hopefully she puts it up.
Well, you've got my vote.
In the show... Oh, thank you. Yeah. In the show notes.
I like every other one of the co-hosts. They're great. And you, Bryce.
Now we're back, mate. We're back, right?
You're my favourite.
Another thing, just a quick one. Today we're going to talk about the topic of struggles people having building a portfolio, Ben.
Yep.
So you and I are doing a webinar next Wednesday night.
We are.
On this very topic. So if people want to check in for that, Ivis will put a link in the show notes as well.
Beautiful.
And this week, interest rates, Ben, we've put a little announcement up on the podcast so people can hear your monthly wrap.
Yep. So the development of that has been the GDP numbers that came out yesterday, and not healthy, right? Not good at all. So GDP grew by 0.2 of 1%, but if you do it per capita, it's the second quarter that we've had with no growth. So we're in a technical recession, two negative quarters for per capita GDP, right? Which means that obviously bigger population, and we've been able to get more growth out of that. And look, it is a story of confidence across the economy, a changing of government most likely. So that in itself is concerning for some. So that's ultimately what we're dealing with here in terms of a crisis of confidence. Some of the data that's also been coming out in February has been a little bit better. Jobs data was good. So, but it's certainly, the RBA gets a fairly good look at those numbers before they're released, of course. They're collecting the data and that's flowing up to the board prior to their meeting. So, the signalling has gone to a neutral bias, but it potentially could go to a negative bias, which means that we might see some rate cuts. Now, the $64 million question, Bryce, is
how many?
How many, and how much is going to be passed on? Because funding costs around the world have actually eased off a bit. But if you looked at the results of the big 4 banks, their profit margin is being squeezed. And I think that is a product of people shopping around and the message getting out there that you could get a better deal if you'd been with a bank for a while. So I think there's a lot of mortgage brokers doing some good work for their clients in terms of doing that. So that margin squeeze is then going to put some pressure on the banks to pass on the full 25% if it happens, right? And we heard Dr. Andrew Wilson last week saying it's going to be April. Now that's, whereas Bill Evans is talking about August and talking about unemployment going backwards a little bit back to 5.5.
Well, interest rate reductions are exciting for existing loan holders, but not so much for people trying to get in, because they'd be more excited about the assessment rate being dropped rather than...
Well, that should happen too, right? So that was my message. I think it's very clear to us now that you're absolutely ridiculous if you're a policy maker and you've got 7.25 as the long-term interest rate. You will not see interest rates back towards 7% in our time, Bryce. So in the next, I'm even going to say, I don't even think we'll get there in the next 20 years, back to that 7% range.
Yep.
So that's got to be taken into consideration. So if the cash rate does drop, you'd like to think that the assessment rate would drop, and that does mean better borrowing power, and we'll see a stabilising. And did you know, I'm going to circle back to the supply side of the story as well. So I think you'll see, we'll give some confidence, because if it's a confidence crisis, we want to get through that.
Yeah, nice.
It's also a great time to buy.
A couple of things, Ben. Good insights. Thank you. We did a YIP article, Your Investment Property Magazine.
Yes.
Our good friends at the YIP Magazine. So we're going to offer that as a free download, which is if you get rejected by the bank, what do you need to go through?
Correct.
So PDF. So show notes, Ivis will have that covered off too. And for all of the podcast listeners, if you don't actually make it all the way to the end of our episode, right to the very end.
What?
Exactly. There's a little spot where I say, hey, there's a free download. There's a binge guide bed.
Yep.
All you need to go to is thepropertycouch.com.au/TPC20.
Yep.
And you can get the binge guide for free.
Beautiful.
Just give us your name and your email address. We'll send it over to you, which is the summary of the top 20 episodes, which we call the foundational episodes. So,
beautiful. Love it.
very good.
Okay.
Mindset minute today, Ben. I'm going to talk about the easy, hard paradox. So think about the front end and then the back end.
Yep.
So if you choose it hard at the front end, study for something, Ben, work hard, build a portfolio, it then becomes easy at the back end, Ben. Mm-hmm. Or if you choose easy at the front end, it's going to be harder at the back end. So if you choose to sit on the couch and watch a lot of telly and not eat well, good things in your head,
food,
all those sorts of things. Exactly. If you microwave food, all that sort of stuff, if you make it easy now, it will be harder at the back end. So think about that, folks. The front end and the back end, you get to choose. Do you want it to be hard at the front, or do you want it to be hard at the back? Because whatever you choose, there will be an easy path, Ben, but it's in which order that you want it in. So
you know what one of my buzzwords is at the moment? Trade-offs.
Okay.
Life is full of trade-offs.
All right.
Work is full of trade-offs. Life is full of trade-offs. So that's the trade-off. Mm-hmm. You go hard early. The trade-off is it'll get easier. But it does mean in that hard period, you're going to have to make some sacrifices, like that delayed gratification. So you'll hear me talk more about
now, Ben,
trade-offs.
I'm going to circle back to the easy, hard paradox in our last question that we're going to go through today, because it's a wonderful story which demonstrates that this particular, and it's Heidi, has written into us. Heidi's going to tell us that her and her partner made the hard decisions early. So now at the back end,
fruits of their labour.
So I'm looking forward. So stick around till the end of the podcast for that one.
Looking forward to it.
And stick around for your Did You Know too, Ben. Okay, so the first one is from Nikki Warren.
Yes.
So book of choice to Nikki. Reach out to us, let us know. Number one, the issues on building a portfolio. The question I asked was, what's the challenges you have in building a portfolio in the current market?
Yep.
Getting loan approval with an exclamation mark. And I've got to say the theme, Ben, is around finance and mindset. And you'll see that as we go through the questions. Getting loan approval. We've been working with a broker for 7 months and now anxiously waiting on the outcome of our second application with a Big Four bank. Mm-hmm. It's been almost 3 weeks since our application was lodged with no lender's mortgage insurance on a simple equity release. So frustrating. The reason I want to say that, Ben, is because the whole banking, because we obviously deal with a lot of clients and they go, and the biggest frustration for everyone in the building is the length of time that it takes to get through finance. We internally call it incubation. And so that's not an uncommon thing. Now I can't, they're talking about a broker, and I don't know if there's any sort of issues with servicing, but let's assume.
Well, one clue there is Big Four bank.
Yep.
They are the ones who are being the most scrutinised. Okay, so they're the lame ducks at the moment. So they're easy to shoot, right? So they are being very cautious about how they're lending. So, and if you're stuck with a Big Four bank, then the challenges are that you want to do an equity release. And one of the things about working with an investment savvy mortgage broker that knows their stuff is that there's a certain way in which you need to approach lending and the timing of the way in which you put applications together to ensure that you have the best prospects of getting funding, right? Now, I'm not going to go too much deeper into that. I don't want to put a big red flag up, but it's just basically saying that We definitely, in reading through all of those comments on Facebook last night, there's people who are getting declined on lending that probably still could get lending, but they just haven't found that right broker who knows how to present the application in the best possible light at the time that they need to present it. In some cases that can mean that there's too much information or not enough information. So it's a bit different. Now, people might say, well, is that gaming the system? I'm like, it's not gaming the system. It's basically working inside the framework. Now, in terms of the work we do, you know that we measure cash flow movements by month for 40 to 50 years, right? Mm-hmm. So we are adamant that our clients are going to be in a position that they can comfortably afford the lending based on the investigations that we've made. So when we put an application up for lending, we're very comfortable with our obligation around responsible lending. Now, the banks may see it in another way, and you've got to remember that APRA also sees it another way. So there are banks who are controlled by APRA, and then there's also some second and third tier lenders that aren't controlled by that. So we still want to be comfortable, and this is why we've been passionate from day one around the ABCD, right? Cash flow management, borrowing power, absolutely essential. If you're going to get into gearing, then you need to do it sensibly, all right? And you need to be able to do it. Now, we think that the levers are too strong by APRA, and that's obviously penalising some of these bigger banks who are also being scrutinised by ASIC and everyone else. So you've just got to shop around. And that's the message to try and get.
And there's two paths that you can follow too, Ben, isn't there? Because what we advocate with our clients is, okay, let's just take a breath and let's release equity and think about, okay, not only the purchase that we're about to make, but if we've cash flowed it for the next 40 years and reverse engineered what a portfolio looks like, we're actually thinking of the second and third purchase whilst we're doing this one. Yep. So that takes some time. Whereas someone can go down the easy path, easy hard paradox, go down the easy path where the bank can get it done in 5 minutes, where they cross-securitise all the loans and they make it happen really quickly. Whereas we're actually releasing standalone lending so that people have choice, so that the bank don't hold the power. And it takes some time. So we get some feedback from clients around that too. But one step back to go 2 or even 3 steps forward, it's worth it. So Nikki, so it's not uncommon that it's taking longer, but the question is whether or not your broker is investment savvy and doing all the right things versus just the bank's handbraking the process.
Yeah, and making sure that you're not doing multiple submissions that's hitting your credit file. So your investment savvy mortgage broker should be making sure that they've lined up their ducks. They're going to show you how they're going to execute on that. And I'll give you an example in our particular business, Bryce. We've been looking to get some funding for our innovation program. So all the stuff that we do, such as the Money Smarts portal and all that, that costs a lot of money. Right? We make it free for people, but we spend, we're probably going to invest over several $1 million over the next 5 years on innovation. And that's about helping people manage their money better. It's about better technology. It's about finding the best opportunities in the marketplace. Now, to do that, we wanted to go to the banks and borrow some money. Now, borrowing money in a small, medium-sized enterprise is hard work. We've been with one Big Four bank for 11 years, and they know everything about us. And the process of trying to get money from them has been very difficult. We then went and spoke to 6 other different institutions to try and get funding. Now, the argument for that, and it's under $1 million in funding we're trying to get, but the paradox has been that I think like our main bank has come back to us and says, we're happy to give you a certain amount. But another bank has also said, no, we've looked at your situation. You guys are great. We can see what the money's being used for. It's about innovating and being, in front of the curve. And that's all. So they're giving us $300,000 more than our existing bank would, right? And they're seeing exactly the same information. In fact, that other bank sees everything about us, the whole lot. So it's just really fascinating that you got to persist. And when you get to that right broker, you will know that you're with that right broker because they will articulate in terms of how they're going to mitigate the bank's concern if you are, pushing the envelope because you're higher risk. Yeah,
we personally experienced a glass ceiling, Ben, where there's capacity for more and we kept hitting it up. So a shout out for anyone, if you've got an investment savvy mortgage broker, great. We rarely do this, Ben, but if you don't have one, you don't know, we are an investment savvy mortgage broker here. So if you need some help, reach out to us and we'd be happy to help you. So thanks for that question, Nikki. Reach out to us. We will give you a copy of a book of your choice. Okay, the next one's from Edmund Ong, Ben.
Yes.
Apart from getting finance, my biggest challenge is whether to sell and consolidate and then regroup or hold and buy more when the market is right. There is an air of cautiousness in the market right now. The fear of are we buying on the down or selling while the price is still on the up is concerning. The calm before the storm. Ben, I don't know if Edmund is in Sydney, but they are getting smashed by negative headlines there. More than, like, we get to see clients across the full spectrum of states, even international, but I'm particularly noticing the Sydney-based clients are the ones that are wearing a lot of that anxiety the most because they're hearing it the most.
Yeah, and I think the clickbait is real, Bryce. I think the data's showing all of these online news publications, the stories that are getting the most clicks have been the property stories. So they're running them, right, and they're staying on it, and it's a continuation of that.
If it leads.
The truth here for Edmund is that if you've got good assets, you shouldn't sell them, right? If you've got ordinary assets, time to regroup the portfolio and have a look. Is this a good time to buy? Mate, it doesn't get much better, right? Now, how long does this window last for? No one really knows, right? You don't know the bottom until you see the bottom, but it's certainly going to play out for at least the next 6 months. And then, given what we're seeing around auction clearance rates and so forth, and what we were talking about, they're not green shoots yet, but there's a stabilisation that's definitely going on, and I think your guys in the field would support that.
Yeah, I mean, we bought one, but as an anecdote, we bought one. We were chatting about it in our team meeting on Monday, and it was in Williamstown. So Melbourne people know that, but from out there, Williamstown's a beautiful little spot, right?
Yep.
And it was a little double fronter that we picked up under $1 million, and there was silence in the room. It's like, we picked that up for under $1 million. It's like, it's amazing buying right now. The position of where it is near Ferguson Street, near the train, there's just so many lifestyle drivers. So we've said it a few times, Ben, but what it is if you ever look at a graph of a market, you'll see it's not linear, it moves up and down. So some people might be holding some property that might, on paper, have come back a little bit, but they're not planning to sell. So as long as their cash flow trades them through this period, it will, because of all of the lifestyle drivers that exist for these properties, they will come back if they've got a long-term perspective. So for me, when I'm looking at Edmund, there's a whole range of things here, but clearly, whenever there's noise, go to the facts. If you can afford to buy a property and you've got a long-term outlook, now is a very, very good time to be buying if you're buying the right assets, and that's another part of the story. But he's also talked about, okay, should I sell and consolidate and then regroup? Well, does that just give you a nice, warm, fuzzy feeling? Because if you sell, you've got to pay an agent, you've got to pay, if you've made a profit, you've got to pay capital gains tax, and then you actually have to get back into the markets. So the next property that you buy has got a lot of heavy lifting to do just to make it sort of break even. So I would say to Edmund that there's a fair, healthy bit of fear going on there, which is fine. But when there's fear, just go back to the fact that if your job is steady, you've got cash flow that allows, and you've got capacity to lend, and you've been pre-approved in advance, now is actually a good time to buy. And
if you do have, so you might have bought an off-the-plan apartment or a house and land in an area that's now oversupplied, then you've got to run the analysis on sell or hold, right? So we taught you that 2 episodes ago in terms of the numbers you need to line up. Or there is a shortcut, and that is to go to the sell or hold platform to put your existing property in and then compare it to the best possible properties in the market for the best suburbs in the market at that time, and you'll work out when your break-even point is, and if that break-even point isn't going to occur in the next 3 years, and it's more likely to be a hold. If it's going to occur inside 3 years, and you've got a long-term horizon, and you're going to be tens of thousands of dollars better off, if not hundreds of thousands of dollars better off over the next 10 or 15 years, that's a sell. Right, and the data will support that. So you'll get a prediction on what the short-term growth is going to be in the suburb for the property type you bought, and then you get to open up the portal and you see all the best markets in Australia and what they're going to grow at, and then all of a sudden you're thinking, okay. So there is potentially recycle opportunity cost here for Edmund, but it comes down to case by case. We don't want to comment directly on his situation because we don't know his personal circumstances, but you absolutely do need to review your portfolio. And if you've got a property that's gone gangbusters, but you think it's going to be flat for the next 10 years, and it's in a regional market or something like that, well, that could be a tradable property, as an example.
And there's a major value add in the seller hold platform, Ben, is you can actually go and check in what all the, be crystal clear on what all your costs are, because some of these are invisible. You don't think about the recycle costs.
Correct.
Whereas if you go through it, it lays it out.
Yeah. You might have had a great capital gain, Bryce, exactly the point. So it may not be worthwhile paying that tax because you've got a tax cost, a large one, that you will need to obviously then address. So that's how clever and the detailed considerations you need to make, because property is not a quick cost in, quick cost out type asset. It's illiquid and it's very expensive to get in and get out.
Very good. So, Andrew, so Edmund, reach out to us. We'll get you a book for that. Andrew Menon, getting the next piece in the property portfolio, taking into account potential future government changes, balance yield play to offset negative gearing, to ease family cash flow, or another growth property, but will add stress, potential too much stretch, but will have the grandfathered negative gearing rule. So there's a bit going on there, but it's about getting the next piece in the portfolio. One of the things Brad and I were chatting about this week was, what do people do if they're trying to make a plan and on the horizon there is some challenges around whether the government's going to change and whether they're going to change the negative gearing rules.
Yeah.
So the question from the client was, well, why would I plan for the future with so much uncertainty? Which is a good question, right?
Yeah.
But the feedback was really simple, because when we're doing the planning, we're quite conservative. So as we talked before, we're doing 7.25% long-term interest rates. So the idea is it's a tax outcome, not a property strategy. So people will still invest if the negative gearing changes happen. But because we're so conservative, if the proposed changes come into effect, the margin that we have on the interest only for 7.25 will probably absorb by the loss in the negative gearing benefit. So still give some clarity around what we're going to do, because the alternative was, well, what are you going to do anyway? Like the time is going to pass, and whether or not this happens, property is still going to be an essential need that people need to live in, and all the fundamentals still exist. So the point being, and I guess for Andrew, is you've talked about the potential future government changes, sure, but still create some clarity about where you're going. Do what you can be in control of, still making sure that you have the cash flow if your job's secure and you're buying the right assets, and may or may not get into effect. So
let's cover off on a couple of points, Bryce. Is the population going to go backwards in Australia?
No.
Definitely not.
No.
And it's one of the fastest growing population, and we can turn that population on through immigration whenever we want to. So if we do feel like we don't have a workforce coming in to support the ageing population, we can turn that on. Right? And what do we normally do? So we're sort of 400 to 500,000 people a year, plus our positive birth to death rate. Right? So we're a growing population. Population by 2035, and 2050 around that sort of 35 million range. Right? So there's going to be a need for housing. Tick. Do everyone gets paid the same? Are we a socialist economy or a capitalist economy?
Sure, we're a capitalist economy.
Right, so does everyone get paid the same wages?
No.
No, so some people get paid more than others for doing the profession that they do. So there's going to be more doctors and lawyers and professionals and tech people who are, now in the next couple of years I'm going to start talking about data scientists, computer science, programmers. These guys are now on easy six-figure salaries, and data scientists in Australia can almost name their prices.
And they'll be 14.
Right, exactly. Right. So where are they going to live? So they're going to choose to live somewhere close and convenient, because they're going to have, these days the millennials, work is life, right? So it's all mixed in together. There's no such thing as separation of that. Where do they want to live? In the bigger cities? How close do they want to live to those bigger cities? As close as they can possibly get, without necessarily being in something that's Lego land or high density. So the land value close to the city is, over the long term, going to go really, really well. So the question here is, so do I worry about the tax implications of that? And also when the building boom, which is what I'm going to do in the did you know around the supply side, when that slows down, the yields will come back. So all of a sudden it's like, what am I investing in? Am I investing in a tax outcome? No, I'm not. I'm investing in the intrinsic value being the land and where that land is located, and the scarcity of the asset is going to, I can get a premium for that, for all the living and lifestyle and the social things that we've talked about, right? Human interest, human behaviour stuff. Once all that washes out over the next 20 or 30 years, those people who chose property are going to be sitting back, and they're going to have a very, very comfortable retirement. And that's what we're talking about. We're not talking about buying 20 or 30 of these bloody things. It's just simple, right? buy 3, 4 really good ones over maybe a 15-year period, you are going to be well served to supplement your superannuation, which isn't going to be enough to match the lifestyle that you're expecting. And can everyone do this? No. I repeat, can everyone do this? No. But we're only looking for 30% of the population to do it, okay? And do you want to be part of that 5 or 10% of the population who retire financially free? That's up to you.
Yeah, and the point always comes back to, do you have a plan, right? So, which sounds a little self-serving because we deliver plans, but ultimately that gives you the clarity of knowing, like, some of these questions are around what if?
Yep.
You know, it's like, who's around the corner? Is there a monster still under the bed? And if you actually know where you're headed and you know step by step what you need to do.
Yeah. But we deliver plans, Bryce, because they work.
Well, they add value to the client.
Correct. They hold people accountable. If we didn't have to plan and you could just do anything, you just would do it, right? But the fact of the matter is, once it's in writing, in front of you, and you've committed to it, and you've got an accountability partner who's doing that, guess what happens? I mean, look at me. You know, this body has not been through a fruit shop very often, right? Has it? God, is it? It hasn't been through a fruit shop very often, right?
You don't get this from a salad, is that what you're talking about?
I mean, there's a few meat pies in this belly, right? And a couple of frothies as well. The point I'm making there is, I've got a personal trainer now, right? Now, do I like going to the personal trainer? No.
Hard, easy paradox.
And if I went to a gym, would I go? If it was just up to me? No. But there's someone waiting for me.
Yeah,
he's holding me accountable.
Yeah.
Right, so I have to turn up. Because, I mean, you know, and that's the point. So the whole idea of planning is twofold. You write something down.
Yep.
There's a higher probability of it working. You work with someone that you're putting yourself vulnerable to in terms of transformation, and you will get that transformation right. So that's why we do plans. If we didn't have to do them and people just listened and acted on everything we said, then we wouldn't have to do them. But that's why we do them.
Yep. So Andrew, good question. Hopefully that helps. But this, again, if you know where you're headed, that's going to give you some clarity around what this does. Because you've talked about here that it's going to put you under a bit of cash flow pressure if you buy a negatively geared property. So that all comes into the equation. So Andrew, reach out. We'll send you a book. This one's from Dim Mastoros. I'm sorry if I got that wrong, Dim. The biggest challenge is finding property that ticks the right boxes. Can I say to you, Dim, a couple of things? One, it's easier now than it has been in the last 5 years. But the question is, do you know what finding property that ticks all the right boxes actually does? So if you don't know that, in the show notes, Ben, as I said at the beginning, we'll have that download, which is the binge guide. We talk about in that binge guide what you can do. So, Dim, why don't you download that? We'll send you a book as well. We'll send the Tagpi one, the Armchair Guide to Property Investing, because that breaks that down. But finding the property that ticks all the right boxes is pretty straightforward when you know the fundamentals. And what we're finding now is. We'll use Geelong as an example. I think Geelong's got wonderful long-term opportunities, but some of the buyers' demand has dropped back a little bit, right? So we're still buying properties, which allows us to be buying against 2 rather than 6 or 7 people. So the biggest challenge is finding the property that ticks all the right boxes. When you find it, the competition's actually lower, and you're going to be very thankful that you bought it going into the future.
I think for me, it's like, I've always said this, that the right property doesn't come cheap, right? There's usually someone else on it. Like if it's connected to owner-occupier appeal and they buy with their hearts, not their heads, if that's the case, then you are not going to just get that property delivered on a platter to you. You're usually going to be under competition. And as you're saying, when it's 5 or 6, some of them are very hard to get. And so if someone's waiting out for that perfect property, if they want to play that patience game, because we've always said, I would buy an 8.5, 9, 9.5, you won't get the 10s. No. You just won't get them, right? No. Because the owner-occupier is just going to go deeper, harder for longer, all right? The other ones that sometimes also thinks people are getting a bargain because they're buying that tired, rundown property, but the dirt's in the right spot. You don't usually get them cheap as well. And then you've got a developer sniffing around that site as well, who's going to turn 1 into 2 or 1 into 3. So it's tough out there. So our view is do your research on demand and supply, look at owner-occupier appeal, best locations, good scarcity, if you can get character, but you're going to have to be prepared to pay for it. So, if you can't do that, what a lot of people do, I mean, how many people have we had who come to us who've said, I've been looking for 9 months, doing my head in, and then they come to us and within 6 weeks they've got a property, right? Because they've got the confidence, they've got a sounding board, because most people chicken out.
Most people have fear holding them back. That's right. So this is a message to Sydney-siders, because we've been helping a lot of New South Wales people buy into the Brisbane market, Ben. And the message is you've got to move quick, because that market isn't lacking competition right now. So they're thinking, well, I'll overlay my Sydney frameworks and my Sydney paradigm here, I'll take my time, and they're missing out on really good properties. So the team is saying, it's interesting across the country, right? Because if you're in Brisbane, they're like, okay, well, there's still a fair bit of demand going on here, but we're in Sydney, we're obviously hearing negative stuff. So
and you go, oh, should I do this? And they go and talk to someone who has no skill. Oh, be careful. And all of a sudden, their confidence just gets a smack. And
then the client says, geez, I wish I... Then you have buyer's remorse, right? Oh, you actually did...
You bought that for someone else.
Yeah, well, not even. We missed it to someone else, right? And it's like, because we certainly don't play clients off against each other, but the point is that they go, well, oh, we missed it. Oh, and they don't get it until later and then go, geez, we wish we could have had it. So it's interesting to know that there's movement in Brisbane, which is different to movement in Sydney, which is even different to movement in Melbourne. I mean, if you're interstate hearing headlines about Melbourne, you think, well, steer away from that. But I can tell you on the ground, in the properties that we're buying that are investment grade, they're still in demand. So Dim, reach out to us. We'll give you that book. Here's one from Pat, Pat Gardner. Pat actually comments a fair bit on our socials, so we appreciate him being very active. I'm having analysis paralysis. Do I invest in shares and not look to property, or do I rent, vest and purchase properties, or put extra into super? Hence my biggest challenge is asset class selection. I feel like a floundering fish out of water at the moment.
Pat, stocks and superannuation are licensed investment products. So we can't tell you what to do in regards to those things, because we don't want to be giving investment advice. I'm on record as saying, and this is a general statement, and it's a statement of fact, which is, if you buy the right share, in other words, you buy the right company at the right time, you will probably, on a percentage basis, i.e. Amazon, or i.e. CSL, i.e. some of the great companies around the world who have a moat and are bloody good at what they do, you'll make a fortune. You'll make an absolute fortune. But it's picking those right properties, right companies, right businesses. It's also about right properties as well. That's the challenge, right? So, and the same sort of thing for, you go and see a financial planner and they will want you to supplement your super. So, and they think it's in their best interest, because they can't recommend property, because it's not a licensed investment product and they don't have any PI cover. So they push you towards buying shares. So my view is this, and I'll give you a little story. One of our staff members was telling me about how he's invested in some shares at the end of last year. So he's got building property portfolio, got a property portfolio already, and wanted to invest something, diversify. Great. Put some money in the markets, had a booming first 6 weeks, thought he was great, and then one of his share stocks went down by 50% in a day.
Gave it back.
In a day.
Oops.
Right? And that just threw him. Right? We talk about mindset and confidence and all those stuff. When you lose 50% of the value of one of your shares, then it does your mind in. This is my view on that. If you can't handle the heat, get out of the kitchen, right? And that's what happens when you are seeing daily stock prices. I was the same in my younger 20s, when I had positions in stocks and they were going up and down and I couldn't understand it, okay? And I didn't really understand the businesses that they were in. I just was told these are good stocks to buy, I didn't do any research. And so I was like, it was playing with my psyche, right? Because that's hard-earned money. And I don't know what's going to happen with that money. So ultimately, that's my view. If you can find, my position on this is, anyone finds comfort in bricks and mortar over shares, good for you, okay? And then you can understand how leverage plays a role in that. But if you are comfortable in buying into businesses that are well researched, in markets that are going to grow, whether it be battery storage or lithium, whatever it is, right? And you can find those businesses and you do your research, or you get someone to help you do that, i.e. stockbroker or whatever, then go down that pathway. But be mindful that the share market's volatile. And if your risk profile is low and you don't like that, then chances are you might explore other things such as long-term super or bonds or other types of investments.
Ben, I was going to use the analogy of the yacht without a rudder. It can get blown around. The reason it can tack against the wind is because it does have that rudder in place. So it sounds to me like, Pat, I would suggest your yacht needs to get a rudder. And so determine which direction you want to go in, because using the yacht analogy, if the wind changes, you can tack and then take advantage of that. But if you're at the moment, because you're fluctuating between 3 different strategies here, get a strategy, get momentum, move on that. Like you say, whichever one you choose is fine. But you need to be clear on what that is, and then you can add different elements to it as well. Because I always say, and I'm certainly not advocating that I'm balanced when it comes to property versus shares, because I'm clearly biased towards property. But what I always say is that the leverage that comes from residential real estate is more superior to the leverage that usually comes from shares. And so therefore,
you control a bigger asset.
Therefore you get a better cash on cash return.
Warren Buffett, just quickly, Bryce, Warren Buffett talks about, if I don't understand it, I don't invest in it. And I think a lot of people, the markets will tell you that a lot of people don't like to buy direct shares or invest in shares because they don't understand it. So the best book for Pat is the Armchair Guide.
All right.
Because that's going to, so if he can understand the concepts in our property investment book, then that's going to be great for him. And if he feels that he can understand it, then you might find him in bricks and mortar.
There you go, Pat. Thanks for contributing to our socials. Reach out to us. We will give you that armchair guide to property investing. How are we going for time, Ibis? How many more can we get in?
We're
Chris,
certainly not flying through them, are we?
All right, let's do the speed date here. Chris Adamson says, dealing with real estate agents, they're very creative with the photos and descriptions of listed properties. Just when you think you have found the perfect property, inspect it only to find it looks completely different. Example, I found a perfect 3-bedroom 1970s flat only to find it was actually a 2-bedroom with a partition cutting the living room in half. The 3rd bedroom didn't even have a light or power points. LOL. Make no mistake, Chris. The only goal of the real estate agent, by putting up the photos and the description online, is one thing and one thing only. It's not to disclose as much information as possible, Ben. It's not to represent the property as best they can. It is to get you to do an inspection.
And you know why?
It is to get you to do an inspection.
Chris, I can guarantee why you thought this was the perfect property. Because you saw 3 bedrooms at a price point that you went, oh my God, that's cheap, right? Only to discover it was a 2-bed with someone who's been clever to manufacture a third bedroom to get a bit of yield and to suck someone into buying it, right? Because that little wall, that gyprock wall that might have cost $3,500. It's just probably added $35,000 to the.
And how big is the living room now? It must be, you can't even swing a cat on it. So, folks, rewind. The number one goal of a real estate agent is to get you to inspect the property. So, therefore, searching is not researching. So, Chris, that is, real estate agents are there to get the best outcome for the seller, not for the buyer. So caveat emptor, buyer beware, check out the properties, make sure you have a look.
We do 500 of these a week, right? And we tune our eyes into looking at the size, the angle of the picture taken, and we can work out size of bedrooms and size of living areas really, really quickly. So anyone who is got to the stage where they've found their location and now looking at properties, just spend a moment to try and see where that camera was placed so you can get the depth and feel of a room. Because you can work out whether that's a double bed, a queen bed or a king bed very quickly, and you can then start to say, do I need to get in the car and go and have a look at it when it's a shoebox?
Now, Chris, Google Earth will be your best friend here as well, so that you can get online, have a look, see what's next door, because sometimes they don't show you the photo where there's a big high-rise next door. So the number one rule is to make sure that you inspect it, or you have a proxy inspecting it on your behalf, who is professional and competent and know what they're talking about. Chris, reach out to us, we'll send you a book. Here's one from Ian. The biggest and hardest thing was just pushing the button, just taking the leap of faith and getting started despite the naysayers and the negativity. Ian, I mean, it's common, Ben.
That's why effectively there's only 10% of the population who are financially free, Bryce. Because you are swimming against the tide.
You are swimming against the tide.
And you'll have buyer's remorse. You'll go through all the different emotions that anyone goes through because it's a bloody high value transaction. But when you come out the other side and life just goes on, you well, say to yourself, why didn't I do this years ago?
So the biggest way to get around that, Ian, is get certainty. Know what you're aiming for. What is your well-formed outcome? What are you going for? Make it crystal clear what you've got. Reverse engineer what that looks like, knowing exactly what you need. Then when you have a goal in mind, it's amazing how people are so much easier to withstand the negativity event of the naysayers when they know where they're going and they are clear on where they're heading. So Ian, you need to plan to become what you plan to become. I think a wise man once said that, man.
Love it.
Sam, Luke, so reach out to us, Ian, we'll get you a book. Sam, getting finance. The banks are in caretaker mode until the government makes their move. That was one. Number two, fear of overpaying is becoming very real with prices falling in a lot of areas. So, yep, good questions.
So, obviously the first one, we've addressed that earlier when we spoke to Nikki's question. The reality is shop around, right? Get someone to do the legwork for you, and that's a broker, right? They get paid to do all that legwork for you. If they're doing it day in, day out, they're going to be able to help you. They're a free service. You don't pay. The bank pays for their services, well documented now in terms of how they're paid. So that's it. Getting certainty around that. But even more so, and Bryce mentioned it really earlier on in the piece, is two things we want certainty if you're going to borrow money. That is that you're in an industry that has got longevity, right? And that you've also got job security. If you don't have job security and you don't have longevity in the industry that you're in, be very careful. I don't think property investing is for you right now. Okay, so they're that point. In terms of fear of overpaying, okay, Sam, let's say you bought a $650,000 property and on paper it was reported to you because you used an online CRM search tool that did a comparison analysis and said 6 months later it's worth $620,000. Oh, paper loss, 30 grand. Not happy, Jan. Fine. Move forward 5, 10, 15, 20 years. That property's now worth $1 million, 1.2, whatever it may look like. Are you happier now, Sam? Are you feeling a little bit better about the decision that you made? Because that's the story.
And a lot of the correction it has been factored into the market. Like some of Sydney has come off a fair bit as well. Melbourne's come off a bit in some places. So it's not as if you're buying at the top. And as Ben said, if you're playing the long game, don't do your comps, get a professional to help you out, make sure you don't overpay, negotiate hard. It's a buyer's market in a lot of places, so make sure you play that to your advantage. All right, let's give away some books, Ben. So that was Sam Wei-Lee, hopefully I got that right, W-E-I, Wei-Lee. Being able to trust yourself in these times. Mind games are not easy. When you are personally going through it with other people telling you what's wrong when you think it's right. Like you mentioned before in your podcast, the best time to buy is when everyone is afraid. That comes with a bit of the challenge. When you want to break free from the mob mentality gets into your head. Nevertheless, I'm in the process of acquiring a property to move ahead. So that was just a reinforcement, but we wanted to read you out, Way, so you get a book as well. Let us know. Here's one from Nick. We're in book mode, Ivis. Nick Sutton. Knowing who or what to listen to, which ultimately causes uncertainty, because we want certainty in the decision-making process. There are so many different sources of information out there about the property market, and there are seldom ever seems to be a consensus. Some days my head just spins. Well, hopefully this podcast helps. Ben, I think we've been consistent from day one on the frameworks, the consistencies, what we talk about. There's been no ambiguity, but...
I'll see if I can clarify that even further, Nick. You'll find that there is a lot more podcasts coming out into the market and a lot more content coming out everywhere in social around systems and processes. What you've got to determine for yourself is, are you a long-term investor, are you a trader, or are you a speculator? In terms of how you're looking at being one of those things, you will know your answers. Because it all sounds real sexy when I made $90,000 in 90 days. And that's the bait. That's the clickbait to get you involved in what you're trying to do and potentially the agenda to work with that business or that person whomever, right? We have been doing this as a business now coming into, I think, our 12th year of being able to do that in generating around $100 million in capital growth for our client base. And we have not deviated one iota from what we said. And Bryce and I have been doing this for over 23, I'm coming up to 24 years. You're 20 plus now. And we are super consistent in terms of long-term strategies to allow customers to understand the intrinsic value of land mixed in with a dwelling on top that will supplement the income over time, and then the value will grow, the income will grow, and you'll live off the passive income. There is no secret formula. There's no mirrors. Yes, there's some minutiae in the cash flow story. Yes, there's some minutiae in the lending and making sure that you're planning the ideal life design that you want to do. And that's why it always should be tailored. And in some cases, some people have to chase yield over growth. I get all of that. But the point being is there is no such thing as get rich quick in this space. If you did, it has been luck. It hasn't been skill. We're in the business of improving our probability of getting the right execution. And that's what we'll talk about today and for the next 10 years.
For the next 20 years. So, Nick, we're no longer in the information age, we are in the insights age because there is too much information. So you need someone to curate the information and give you the insights that you need. So as Ben said, if you want to get rich slow program, you're in the right spot with our podcast. If you want to get rich quick program, you need to go and find another podcast because it's not for us. But you need to find someone who you trust and believe in and follow the insights that they're giving, not so much the information they're giving. Reach out to us, Nick. We'll give you a book. Let's quickly give away a few more, Ben. Being brave enough to take the first step. We've almost purchased a first investment property twice and pulled out both times. Cold feet and knowing who to trust and if they really do have your best interest at heart and when and where is the best time and suburb to buy. I think we might have covered that. That was from Lisa Walsh. But we read you out anyway, Lisa, so you get a book, reach out to us. Jim, anything to add there, Ben?
Well, it's just more of, if you can't execute yourself, it's because you don't have anyone supporting your positioning. So that's where a buyer's agent can be very, very helpful for you because they are going to give you the confidence, as someone mentioned earlier, Ian said, just pushing the button, right? Signing the paper, whatever it is, they are going to give you that confidence because if you're pulling out twice, something's not right. There's a gap in your knowledge, there's a gap in your confidence, there's gaps. And so you need those gaps filled in because once you fill them in, you'll have peace of mind and you'll move forward.
And Lisa, do you know where you're headed? What are we aiming for? Do we know which way we're going for? So let's help you with that. Reach out if there's something we can do to help you. Jim, getting the equity built up in a property, job security, and what the next government brings. So a bit of uncertainty around that.
Yep. So again, job security, we will highlight that again in these uncertain times or changing times. Not uncertain, but just changing. Equity build up in a property, well, that's buying in the right location. That's pretty straightforward. Governments, they play a role, right? But this is where Picker comes in terms of making sure that you join the association for $5 and then, with 2 million property investors out there, if we can build up to an adequate size, we will have influence and the ability to also look at how, you've seen how the mortgage broking industry is mobilised and had some success. Same could be for us in terms of tenancy reform that's going on and other regulatory changes that's going on. So, if you haven't already joined for $5, jump on Picker, pica.asn.au/join.
Well done. Okay, so, and here's the last one, Ben. I've got, there's a few more folks who we'll get to you eventually, but Ivis is winding me up here. So last one here this is from Heidi, Ben. I talked about it at the top of the show. Hi there, Ben and Bryce. I only discovered your podcast late last year and have been gradually getting through your past episodes. What I love most about listening to you is that it validates the path we've been taking in real estate for the last 20 years. My husband and I both turned 50 last year and started the year off by retiring with a passive income from real estate of $120,000 a year, Ben. Just a little over $2,000 a week. We currently have some dollars to spend on a property, but are having a few decisions to make. Aside from the lack of stock that ticks all the boxes, in brackets, looking in the beach side of Adelaide around Glenelg, close bracket, do we use the cash to buy one property outright or buy a couple and loan half the funds for each? Also, our current portfolio of 9 properties, including our home, has a total yield of 4.4%.
Nice.
If we buy outright, do you think it's okay to buy a lower yielding property, i.e. family home with land in the area will average 3.5%, knowing that the capital growth in the area is reliably good? Would love to hear your thoughts. Love your work. Heidi Johns. Ben, Property Investment Advisor of the Year, that's a layup for you.
Well, I mean, it just goes to show that you do this over the long term. You build up a passive income of $120,000. Now,
Heidi, if you're listening to this, can you please reach out to us because we want to get you on the podcast.
Yes,
and have a chat to you.
And the answer for them is going to ultimately be in what lifestyle they want. Like, it's actually really clear. Like, Heidi, congratulations, you've done enough, right? You may not even need to buy these other properties, right? It might just be about just retiring the debt out So long as you've got your dream home and you've ticked all the boxes in terms of the lifestyle design you wanted to do. That's my story here, right? It's like
risk profile.
Risk profile, big rocks in the jar. Have you got what you want? Don't keep going if you don't have to.
No, go and enjoy life.
Go and enjoy life. Now, this could be, it sounds like, someone's hobby can become their passion, right? And that's okay. So if that's really important to you and your partner, then terrific. But I can also say to you is like, you just need someone to say, hey, well done. No more.
Yeah.
Right? Get that money working, go off and travel Australia, do whatever you need to do if 120 was your target. If you're going after 160, 170, 180, because you might be on a really high income, right? And you want to supplement 200,000, whatever it may be. You've done a lot of the hard lifting early, so it's just fine tuning that. And that's what my advice to you would be.
Very good. So Heidi, invitation to you to reach out to Ibis. We would love to unpack that backstory a little bit more on a future episode of the podcast. We'll be very gentle on you, so please reach out to us.
Beautiful. And thank you for sharing.
Yeah, so thanks
far.
everyone for all your questions. I think we've got through a fair few. Reach out to us. We'll send you those books. We'll try and do this again on our next Q&A, Ben. But my life hack today, Ben, is just finishing off the benefits of the 7-day float. We're on a mission to get people to do the 7-day float.
We are.
The last benefit, Ben, is there's no tracking required. You worked out what you wanted to spend this money in the planning and setup phase, if you're following the money smarts.
Yep.
So you're free to go ahead and spend it. You don't need to track this account at all, Ben. You don't need to micromanage it. You said you got to spend it. All you got to do is look on your bank app, Ben, and say, do I still have some money left over before the end of the float period for us, which gets replenished on a Thursday? If yes, keep spending. If no, mate, open the pantry, open the fridge.
That's it.
So no tracking is required. That is a relief. That is one of the reasons why people don't want to get involved in the minutiae of managing their money, Ben, is because they don't want to track.
Well, that's why budgets don't work, Bryce, because they go back to old habits and they don't follow routine. They don't want to then go, I've got to do some paperwork. I've got to do my numbers. I'm going to get my bank statement and all the things. I can't believe I'm putting $2 in for a can of Coke. And then I've got to so I'm spending an hour tracking all my. You don't have to do that with the living and lifestyle
Just
account.
spend it.
You said you were going to spend it. There's your bucket of money. That's your blow money. Go for it. Spend it.
So Ben, I've covered this in my life hacks over the last little series, but it's number 1, it's treated like cash. 2, it helps you spend less and trap more. Number 3, it encourages a make it last mindset. Number 4, it stops slippage. Number 5, it teaches you about conscious versus unconscious spending. And number 6, there is no tracking required. So Ben, I invite every single one of our listeners who is not doing a 7-day float, who's not doing money smarts, to go to thepropertycouch.com/Ibis, make money simple again.
Yes.
That will get you to our free platform. You fill in your details, you'll be able to work out what your 7-day float is, Ben. It will transform your money management. Go ahead and do it.
And Bryce, I've got a special announcement.
Oh.
A very special announcement.
I like it when you bring the tone down and you pause.
Pause
for
effect.
Yeah.
In the next week or two, subject to a bit of testing, This is what all that money's going into.
Yes.
More stuff on the platform.
Yeah.
We're going to announce a game.
Oh.
The game.
Challenge.
That's all I'll say. There's a big challenge.
All right.
I'm going after all the people who think they're good money managers. I'm going after all the people who think they're good money managers.
Well, you've just got the engineers who've pricked their ears out.
Right, who think they're okay at money. I don't need to do this. Well, once you see what we're about to do, let's see how good you are.
So how can people get involved in that, Ben? They go to the Money Smarts register and they'll find out first, won't they?
Yes, they will. All the information we'll be working on and we'll launch that in the next week or two.
Plus our Facebook group is gathering steam, Ben. There's that community is building up. They're talking to each other. So if you're a Money Smarts person, you want to talk to other Money Smarts people, get on board.
Well, there's lots of great questions that are being answered by everyone. So that's the whole point in terms of helping people organise their money. And when you organise it, you are unstoppable.
Yeah, love it.
Because you can trap surplus and then that money goes to work for you, and that's transformational.
Love it. Hey, Ben.
Yes.
Did you know?
Did you know, Bryce? Well, I did wanted to talk about supply side, right?
Yeah.
So I just want to give you some numbers of the change in supply that's going on at the moment. So in November 2017, not last year, but the year before, and if we all remember, that was sort of the peak of the pricing cycle. Certainly it was in Sydney was August and Melbourne was November 2017. approvals, housing or building approvals, I should say, dwelling approvals, 23,000. Extrapolate that out, right? That's 276,000 new dwellings, right? Now, if you have listened to a lot of our podcasts, you'll hear me talk about that the system norm is about 150, right? So the last 20 years, and that's why there's been a chronic undersupply of property, right? Boom comes through, construction boom, money's cheap, prices go up. The world thinks a property is an unbeatable investment when it's not. You've got to pick the eyes out of it. Fast forward now to December 2018, we had 13,995 approvals.
Yep.
So we extrapolate that out over 12 months, that's 167,000. Right. So we've had obviously a significant downturn in the forward estimates of construction. That's been well documented. You hear me talk about it on the RBA announcement that I do every month. But it also highlights that if we're going to keep tracking to system norm, and if system norm is around that 150, that is a shortfall. We need to be around 170, 180,000 dwellings just to meet the market demand.
Yeah.
So that is also going to turn property prices to flatten out. Even if the demand side doesn't drive property prices higher for the short term, this is going to help with the floor, right? Because there's going to be less construction. And as those properties are absorbed through population growth, we will have an undersupply. So this is just giving you some idea of what's going to be happening. So, and this is why it's cyclical. You have boom, big constructions, lots of jobs, and then, you know, basically correction. And that's when we're seeing, okay, slow down in that. So if that continues, we do know that there will be a bottom in the market sometime soon. But if we also see lower interest rates and more first home buyers and potentially some investors coming back in because they're seeing opportunity, then we may not be too far off the bottom, more broadly speaking, across the Australian property market.
Good, did you know, Ben? I like that. But so big episode, Q&A day, one of our favourites. Again, folks, if you're still here at the end of the episode, if you could watch tonight, Escape from the City, that'd be awesome.
Yes.
Go and download those free downloads and the webinar next week. If that is of interest to you, we'd love for you to come along and have a little listen to what we're doing there, Ben. But until next week.
Bryce, knowledge is empowering. And hopefully you've got a fair bit of knowledge today, but only, and this is the problem with people with mindset, if they act on it.
Never been truer, Ben. So there you go, folks. We'll see you next week. Folks, we hope you enjoyed this episode. Just a quick reminder that this is general advice only, and you should always consult a professional advisor before making any investment decisions. And if you haven't had the chance to go back to the foundational episodes, we've got good news for you. Go to thepropertycouch.com.au/TPC20 and check out the free binge guide, which gives you the insights you need from the first 20 episodes, where we unpack the foundational pillars of the insider's guide to property, finance, and money management. It's completely free and available now.